Hello, everybody. Welcome to the Blockchain Acceleration Foundation's weekly meetup. My name is Cameron Dennis. I'm the president and founder of this organization, and we're a 501c3 nonprofit that starts accredited blockchain courses at universities. We get people jobs in the space, we build a bunch of projects together, and just really doing whatever we can to push this industry forward. Today, I'm here with Nikita Buzov from Solace. And Nikita, if you don't mind, just turn on your mic and camera. He is here to talk to you about DeFi insurance. This is a very hot topic. It's still a very untapped market. There's very few players in the space, and Nikita is here to tell you all about his new startup. So Nikita, if you want to further introduce yourself and take it away.
Yeah, thanks for having me, Cameron. My background is in computer engineering. I just recently dropped out of a PhD program to start Solace and pursue, DeFi coverage insurance space to build a protocol so people can yield farm and utilize all the financial products in a more safer manner. So let me start sharing the screen and can get rolling. Also, just a quick note, ask questions whenever you have them. I'm going to be looking at the chat and we can have more of discussion than me just talking. So I would appreciate any questions. Okay. Can you all see the screen? Do you see my presentation? Okay, I think yeah. Okay. Cool. Well, let's get started. So yeah, today's talk is going to be mostly focusing on DeFi insurance space. Just going to go through the overview, and then I'm going to present what we've been working on and what value we're providing. So I'm sure probably most of you have seen this chart, right? It's the total value locked, and we all have witnessed this blow up in amount of value that is utilized in DeFi and decentralized finance products, all these protocols that are popping left and right. We have seen a sudden drop recently, a pretty big market correction in the last few weeks, but either way, it's absolutely clear that the space is growing, and there is clear need for all these different tools to build efficient markets. So there is a problem with financial losses, because we have all these DeFi blow up, tons of money flowing left and right, but with it, obviously the adversarial minds come in, because now it becomes a very interesting piece that people can attack. So in 2020 we lost around 200 million in DeFi, but in this year already it had crossed almost double that amount in the last year, and who knows how much more we're gonna see in losses. And here's just a quick list of some of the projects and how much they lost and when. This is obviously not exhaustive, and I just included some of the projects that I personally like. There are a lot more to it. So the question is how do we lose all that money? Because the promise of Ethereum, DeFi, promise of the whole blockchain space is just, oh, wow, this is awesome, this is secure, we remove all the intermediaries, it's great, right? But how do we lose all the money? Where's that coming from? And the answer is just the exploits and hacks and stuff, because now we're dealing with code. There are no people double checking everything, or these random systems, right? So smart contracts do have inherently vulnerabilities, because the blockchain is safe, right? But then people write code on it. You can think of Ethereum as, it's just a distributed computer, right? That people write code and then deploy their programs. But the programs that we wrote can have vulnerabilities, problems, errors, bugs, just like any other, app on your phone or program. So here I just present like a short list of a few very popular exploits that a lot of protocols kind of overlook sometimes. So the one obvious is like minting vulnerability. Like what if you just can mint some tokens that have a value that you're not supposed to? Like, if I could print dollars, I could flood the market with dollars, right? That's a clear exploit. And then flash loan attacks, where a flash loan is just it's a loan, but the one that you can take out and return in the same transaction. So, but between those transactions where you take it out and return it, you can do some interesting stuff with it. Basically, some manipulation with price oracles, or just sway the markets, or like exchange rates. Then another one is like fake tokens, where basically you can trick some of the programs to think that you're depositing one token versus another. It's also like very interesting hack. And then proxy manipulation, basically, because like contracts can call other contracts, right? Like the whole ecosystem is interacting with itself. And so now if those interactions are not properly protected, then you can have those kinds of manipulations. The next one is probably like more easier to understand. It's like math. Like if you're not careful with math, a lot of things can go wrong. And so there are a lot of errors with that. If you use incorrect exponents, or get some like overflows, which is, I guess, like more technical than math. And then one of the most popular and one of the very first ones out there is like reentrancy. And actually the code on the right, that's the code that was hacked pretty much like a while ago, with like reentrancy. Because if you look at line 9, we do make a call to like other contract. Basically, you send the money and then you do the updates internally, and so somebody can keep calling the function and keep like sending out the money without the first function like completing its run. So basically the reentrancy, what it means is that you can come into the this function calls without the function being completed. So it's like a recursive call. But maybe I'm getting a little technical here. So we have all these exploits and problems, and we're losing money, right, that sit on all those contracts. So here where the DeFi insurance comes in, the promised land, all these coverage products that are out there, trying to mitigate those losses by offering like various kinds of products. And there are a lot of different approaches, but right now there are kind of like 4 major questions out there. Like, so just like in the traditional world where you have your insurance companies and they underwrite your risk and price it, the same thing we have to do in this space. Like, who's the underwriter? Who's going to like put the capital down to back the risk? How do you price that risk? How do you track the capital to compete, with all other yields? Because insurance companies are basically operating like funds. They have a lot of money that they invest, and they need to produce returns for their investors. Same thing here. And now we see DeFi has a lot of like pretty good yield. How do we compete with that? And so then it all kind of loops back into the capital efficiency, which is a common challenge for a lot of different financial spaces. And then how do you process claims, determine financial loss? Because we know all these hacks are quite complex sometimes, and unclear of like how do you go about evaluating like, oh, who lost what, and like who's there to blame? How do you even evaluate and validate whether it's a true or wrong claim? I don't see the chat when I present, so like let me just hop in to check that. Yeah, okay. No questions so far, but let me know if you do. Otherwise, we'll keep going. So let's just take a look at leading players out there right now, and like what they do, what their approach. Because as I said, there are a lot of ways you can go about solving this problem, and right now it's still very much unclear of like what's the best way to do this. The space is so young. The whole DeFi just blew up, in this past year, and so it's very fluid, and a lot of innovation is happening. Um, Most of you probably have heard of like Nexus Mutual, which is a pretty big player. There were like one of the first ones out there to even come up with these kinds of products. So basically, Nexus Mutual is a mutual, right? You can join as a member, and then all of the members share the risk together. They can buy coverage for themselves on like different protocols. So like when they utilize them, if they go down, the mutual will cover their losses. And the way they price risk is one of the, I guess, more popular approaches. Is a community voting. So basically, the way you can manage the risk is just ask every member in the mutual, like, what do you think? Like, how secure or how safe protocol A is, and how safe the protocol B is. So let's say you get 10 votes, and then you can place them into these like different buckets that represent each protocol. And so that's kind of like one way approach. But then you can, I think, already guess that like the people that are in a mutual are not necessarily professionals in the space or have the best perception of like what the true actual risk is, right? It's sort of an opinion, so it's very easy for community voting to improperly price that risk. Um, and so another approach is a prediction market, right? Because you can, let's say, you think that a protocol like Uniswap or Aave or Compound can get hacked, and so you can place a bet that it will get hacked, while other people can place a bet that it will not. And so you basically open up that prediction market where people are betting on two different outcomes. And when you bet on one outcome, that provides you with coverage, because now when an event happens, one side of the pool is basically worth zero, while the other um, get all the value in. And so by participating in the prediction market like this, you can actually get your coverage. So both Nexus and Cover, they use committees to validate claims. That's kind of like on another side. Let's say like in the event of a short poll hack exploit, now you have a coverage, right? You purchased it. How do you go about getting your money back? And both of those projects, they basically say, okay, you open up the claim, and then we have a committee, we have people to validate those claims. So people can go check, and then if they think that the event actually happened and your claim is valid, then they're gonna submit the transaction and pay you back. So that's kind of like a committee approach. But just like with any other system of committees or like people involved, it's naturally slow. It could be biased, and then also it's just like you have to submit the claim to and like wait a while for them to like process it, and then it's just kind of like a drag when people have to do it. So it's not the most, I guess, fluid and nice system that people would like to see, especially in the space like DeFi, where we expect high liquidity and everything, where you can like come in and out of any protocol at any time, and then all things are automated and almost instant. Another way to like approach this whole space and issue is derivatives, right? You can buy options or futures and kind of execute these more complex strategies to protect yourself from these like shortfall events or exploits. But these financial derivatives right now, they offer very limited product line because, for example, options like on open, they can only protect you from like a price action on uni token, for example. And often they require somebody to open up the market for the options because somebody has to sell that option for other users to buy it. And so you kind of run into this problem where the availability of the products is very low. And that same challenge is faced by the prediction market solution because you have fragmented liquidity, you have isolated pools. Basically, each market for each protocol is a separate thing. You cannot pool the risk together across multiple products or protocols. And that's another issue that causes low capital efficiency right now in the insurance space in DeFi. And then I also have like a column here for KYC, which is know your customer. Basically, to be a part of Nexus Mutual, you have to actually go through verification, and then you do become an official member of a UK mutual. So it's not really, I wouldn't say it's like in the best spirit of decentralized finance or like open finance and the whole like blockchain space. Because right now I'm not a part of the mutual and I cannot just go and buy coverage if I want to. So, taking all these issues together, we've been thinking about how do we solve them? And is there a way to take all of that together and piece a protocol together that can be, more efficient, provide better risk management, better claims assessment, and wider product availability, along with just, kind of like tailored risk exposure to provide higher leverage on the capital so we can like sell more coverage than the capital is. So basically kind of like what traditional insurance company, like how they operate. And here the chart in front of you right now is just presenting the whole protocol and how different kinds of users can interact with it. But let me first check back to the questions. Oh yeah, I see Cameron said that open is confusing to use. It is. I have tried myself, and I was like looking into utilizing options to like execute my investment strategies and how I can better like hedge the risk on my investments. And I ended up not using them. But they've just recently deployed V2, and I think the growth there is pretty good. But we're still kind of like a long way. Options are a complex tool to use, and so I think it's kind of inaccessible to the most users to like grasp right away. But anyways, let me get back to this. So you kind of can think of Solace protocol as a protocol where you have two types of users, right? On the left side, you have investors, so people who are providing capital to underwrite the risk, to back the risk of the protocol. They're going to be, in a sense, selling that insurance or like coverage product in our case. And so they deposit their ETH or liquidity, other tokens, perhaps in the future, to back the risks of the protocol. And then the second kind of user is the coverage seekers, people who want to participate in DeFi, people who do want to utilize all these financial products, who want to like put their tokens in Yarn or provide liquidity on Uniswap, but they're a bit more risk averse and they would rather not, worry about the fact that their money can be stolen by somebody. So they come in and they can buy coverage for their positions. So we offer multiple products and then they come in and buy coverage for whatever protocol they're utilizing. And so internally, we have to do the risk assessment, right? And so the risk assessment, what it does basically, it sets the prices for the products, like how much premium do we collect for the policies, and sets the capital requirements for the investors. So we can kind of manage the whole risk portfolio of the protocol. And that risk assessment model is managed by the decentralized governance. And that's what you see on the right side of this chart, where community stakeholders, they kind of govern and control all these aspects, basically how the token distribution, how the rewards distribution goes. They manage how the investment is performed within the protocol. They do manage the risk, as I already mentioned, and also support, obviously, the most important piece of this whole system, products. They help and provide capital and workforce to develop, release, update new products, and just generally support the ecosystem. Oh, okay. Oh yeah, I see there's a Q&A section. Sorry, I was just checking the chat. Okay, let's go. Can you explain a little more how flash loan attacks work? Yeah, basically, so for the flash loan attack, you can think of, let's say, a flash loan. You take out the loan, right? And then now you can go to Uniswap or some other exchange to buy or sell one token versus the other. So you can go and trade with a loan. Let's say you buy, like you get a huge loan of, I don't know, like $100 million, and you come into a trading pair that has like low capital. So basically with that $100 million, you can sway the price a lot. So you can inflate the price by buying like that's asset A, for example, with that $100 million. So now you can push the price with the loan. What if some other protocol is using that price to appraise or like evaluate their token on like one end or another, or their activity? So now you can come in, inflate that price drastically, and go to that protocol that is vulnerable and basically fetches the price. So now you're forcing that protocol that is outside to fetch the incorrect price, and that allows you to do a lot of like different things. Basically, like for example, let's say you have like a token that is tied to like value of, like, let's say you have a token A that is tied to token of value B, token B. By inflating price of a token B, you're effectively inflating the price of a token A, right? And so the protocol that gives you token A versus token B can now give you token A for, like, give you much more of that token A than you would have gotten without that flash loan. And so basically then you get token A a lot more than you should have gotten. You sell it on the market, pocketing that difference, and then you can return that flash loan. All of that happens in a single transaction. So it's a chain of executions that get added into a single Ethereum block. And basically, you take out the loan, you inflate the price, you get some asset out of it, and then sell it, return the loan, and pocket that money. So that's kind of how it works. I hope it makes sense, but let me know if you would want me to elaborate on that. And so, okay, the next question: how is Solace designed in a way that it doesn't need KYC? Basically, it's a decentralized protocol, open, just like most of other DeFi. You can come in, and I'll show you later. At the end of this presentation, that you just connect the wallet, and then you can deposit capital, you can buy coverage, and do all of that. There's no KYC because the protocol is not like a legal entity in any of like jurisdictions. You can think of a protocol as a piece of code running on its own in the internet. And so, there's nobody to check the identity. Nobody like really knows who you are, just your address. And so that's kind of like in the nature of open finance. That's why people develop all these programs that can run on their own and not be like owned by anyone. The whole idea of decentralization comes in it. All right. Oh, I see another question. So doesn't that open the door for collusion in the market? Is collusion in the market, what exactly, could you elaborate? That meaning what? Okay. Michael, are you talking about the collusion when you do KYC, or is that referring to the? All right, I'm not sure what you're referring to. Just yeah, just like please elaborate on the chat, and I can come back to it. All right, but let me continue. I mean, this chart just kind of shows the architecture, but let's talk about like what's the value proposition, how Solace is different, and like what we offer basically to mitigate that problem. So the product that we're putting out there is a coverage policy for liquidity providers. As I've already said, you want to participate in DeFi, you want to utilize these financial products, you go in and deposit or stake your tokens, your liquidity, your money, and now you do want to purchase coverage, so you're protected. That's where we come in. You can come and purchase coverage policy that will cover you in case of any of these kinds of like exploits related to smart contract vulnerabilities. And what we do differently basically is like the way we approach risk management is fundamentally different. We don't rely on voting or any of these, as you say, like public market machines. We build in-house like our own risk assessment model based on like mathematics, statistics, probabilistic models. There are already some historic values out there because of all these hacks and all these protocols. Even though that's not a lot, especially if you compare that to the traditional insurance space where they have decades of data. We only can rely on the year, but the whole model is obviously also uses some heuristics and some both combination of quantitative and qualitative measures to evaluate risk. But our idea is that we don't want to outsource risk management to just the public. We do want best people working on risk model. We do want to take responsibility to actually push the space forward on the risk management side and have robust models that can more accurately price the risk and manage the risk portfolio across the protocol. And so like another major difference, as I said, all those claims that other protocols are processing right now, they're done through community voting or like committees. Sometimes it's like in the case, of a mutual, you would have like all members vote whether certain like events happened or not. But then for a covered protocol, for example, you have a committee. So you do have like a smaller group of trusted parties that you trust to evaluate the claims. What we do is we've built a system that automatically processes and validates the claims. So that's a system that can see what your positions are, see how they have changed during some shortfall event. So if there's like any hack or anything happening, we know what the financial loss you've carried. And then when you submit a claim, that claims assessment system can immediately see and validate your claim and also submit a payout. So it's completely automated and transparent. So you can like see right away what's the status of your claim and like what your payout is, like and how much you lost. So that's the system we're built. And another very central part and very important part to our protocol is that by evaluating the exact financial loss, we can actually optimize our risk exposure, because now we only make payouts in whatever you lost, not your full position amount. Because all these protocols right now in the market, they ask you to just input whatever coverage amount you want to purchase, and then they're going to make a payout in that amount. What we're doing is we actually cover your actual positions instead of your claim of you having a position somewhere, right? So we go and see that, all right, you are a liquidity provider on the protocol A, and here's your position. We're covering that position, and then in case something happens to it, we're covering whatever you lost there. And so that helps us to like really tailor the risk across the protocol and all the products. So that's a major improvement on the capital efficiency, and ultimately down the line can allow for us to tailor the risk, control how much capacity we have across different coverage products, and also just the better user experience, because then your actual position is covered, and then you know that we're going to make a payout in the financial loss. All right, I'm going to come back to the questions now. So I have another, okay. So yeah, borrow and lending one coin with intention pump another. So that doesn't really open like a collusion in the market, because you can't, like, let's say if the two protocols try to like steal the money, they still like need to inflate the price, and they need to, like, let's say, take out a flash loan. You cannot really artificially inflate the price if the code doesn't allow that. So if like in case a protocol is want to like steal funds from you, they don't really need to collude with anyone. It's basically written in the code, like all the code is public, so you can like technically always see if they have the proper checks there or not. And there have been a lot of what's called rug pulls in the market, where you have a protocol basically putting out their product and pretending that they're providing like value or like yield to their investors, and then one of a sudden just escape with the funds. So like collusion doesn't really happen in the space. Okay, the next question is, how are you going to ensure competitive pricing of Solace coverage? So that all kind of goes back to how we manage the risk, right? Because that's the price for the coverage comes from your risk management, because you always want to at least break even in the worst case scenario, right? You sold a bunch of policies, you made some money, and then something went wrong, and now you have to pay out claims. Ideally, you would have enough money from the premiums to pay out those claims, so investors are actually not losing money. And so to offer the best price, you need to manage the risk properly to make sure you're not overexposed, and you can basically, like, you can leverage the capital, because now you want to collect a lot of premiums, right? And you have limited capital in underwriting all of those policies. So the insurance companies in the real world, what they do is they sell more coverage and take on more liability than they actually have assets, because they can confidently say that across their portfolio, not everybody's going to open up claims at the same time. So let's say if we cover protocol A, B, C, D, so like 5 protocols, if we confidently can say that 5 of them are not going to fail at once, but like only one, then we can predict how much are we going to lose in case one of them fails. And from that, we can offer, a price, a premium that we don't want to charge. And so we can sell a lot more than what we have in capital, because we have the confidence that not all of that coverage sold is going to get sacked and like basically claimed. So that's kind of like, basically you provide better competitive pricing down the line by levering up and like increasing the capital efficiency across the protocol. And I mean, it's not just about risk management, like, claims management, for example. Like when you make payouts only in the financial loss amount, you're reducing what you're actually like paying out in claims, because you can think of, let's say your position is 100 ETH and then you lost 20 ETH. In case with Nexus Mutual, you would have bought coverage for 100 ETH. Nexus Mutual would have to pay you out 100 ETH, while we would only pay you out those 20 ETH that you lost. And so you can see already how much more efficient a system like this look like. And that basically allows us to have lower prices on the premiums, because now we don't take as much liability on when we provide coverage policy. I hope that answers your question. Let me know if I need to elaborate more. But okay, let's move on. Oh yeah, the juicy part. Okay, so yeah, basically you all can go to Solace.fi and then access the app on there. So let me just quickly show you what it looks like. So let's start off. So if you go to Solace.fi, you'll see our landing page there with links. You can read the white paper, the team, and basically just all the information about it. I highly recommend you to follow us on Twitter, join on Discord, and just engage with us. We are looking for people to provide feedback, to just hang out and provide their opinion, reviews, and stuff. So come chat with us. But also you can try using Solace right now. We have the web app. So okay, let me unlock the wallet. So here's the app. Basically, on this app, you would buy coverage policy or invest your capital. So right now we're deployed on Rinkaby, which is a test net. We're not on mainnet, so don't send any real ETH to any of these addresses of the contracts. That will result in the loss of funds. But basically right now, in my account, I have like 5.5 ETH that's on the Rinkaby testnet. So I have been yield farming a little bit, so I have accrued some rewards, which are obviously on the testnet. And so here's how it's going to look. You have your coverage policies basically for, you have liquidity on Uniswap. You bought a coverage. You'll see it right here. You can open a claim, you can edit the coverage, you can renew it. So you can change the amount that you want to get covered for. And the expired policy will have, you'll be able to just like view them. And then your investments, as I said, there are capital providers, so you can act as both the user who buys coverage and also provide capital to earn yield. So let's go to the Invest tab. As I said, we have the risk backing capital pool here that you can deposit funds and then earn yield on it. So let's try that. So here we can choose how much we want to deposit. Let's say I'm just going to deposit 1 ETH, choose high gas, so the transaction goes fast. And then, so in order to accrue rewards from the protocol, you need to stake your shares of the pool. So if you want to do that, just click this button, click confirm. Okay, now, okay, so the transaction is pending right now. Let's wait till it gets mined. You can also like check it on Etherscan. So right now you can see it's pending. Here's the hash. So it should take about like 10 seconds. Yeah, okay, so the transaction has gone through. Now you can see that, my assets went up. I'm like my pool share. I'm one of the very few right now who has deposited. So yeah, and then here's my balance of like the rewards that I've accrued. And then we have basically, farms, which are accruing rewards. Right now, I'm just participating in like the Solace Capital Provider farm. That's the one that provides the Solace token rewards at the moment. And I have not deposited any like Solace ETH liquidity. So at the bottom, you can see the transactions here. So if you ever want to like revisit or check those out, like if you click on a hash, that shows you on Etherscan your transaction. So the quote tab is still under development. This whole app is still very much under development. So I would greatly appreciate you guys to just go in, click buttons, break it, and tell us on Discord about like your experience, what you like, what you don't like, what doesn't work, and yeah, also the govern tab is also under development. So all the voting will be happening under there and the control of the protocol. So yeah, I mean, this is pretty much all that I had for you today. I'll stop sharing the screen now. All right, we have 2 more questions. How did you come up with the idea? So, I mean, I've been in the space for what, like 4 years now. Started off with like mining. So I was like building mining farms and stuff, and then slowly transitioned into coding. So when the whole like DeFi space kickstarted about a year ago, I was heavily participating in all of that, like utilizing different projects and stuff. And then Nexus came about like during the in like September, as well as like Cover Protocol. They were kind of like in active development, and then I think they launched in October. And so at that time, I was like, awesome, these coverage products showed up. So like now I don't have to worry about like losing my money. And what ended up happening is just like I just didn't like their products. They were either very expensive, so it didn't make sense. Like, you don't want to pay your like month's worth of yield, right? Because like it doesn't make sense. Or they, in the case of Nexus, they required KYC, and like me becoming like a part of this UK mutual, which I kind of repelled the idea. Like I don't want to be part of that. I really like the idea that things are very open and decentralized, and anybody can utilize any of these tools. And so I started kind of like investigating like what's the problem, and if like I can provide any value and like build something that people can use. So it was an idea that come from like a user perspective. I just wanted something that wasn't there, and I was like, why wouldn't I build it? Like, so I just kind of like pursue that. All right, and then the last question I see: when are you going to launch a mainnet? When can people start investing? So we plan to launch on mainnet in June. So that's another reason you guys should really stay current. Follow us on Twitter, join Discord to like stay up to date on what's happening when we launch. And we'll first launch with just the product. There won't be a token. So our plan is to launch the platform, show that it works and stuff, and then push for decentralization through just like token distribution. So when can you start investing in Solace? That's also a question that you'll get answer from Twitter when it comes to it. All right. Are there any more? Oh yeah. Also, yeah, Kush. So Kush is one of my co-founders. We've been working on this for months. So he just posted a small survey. So I would, you guys should go fill that one out. I would really appreciate your opinion and your input, because as I said, we're very much community driven and want to involve as many people in this as we can, to provide better products. Because as I said, I came with a problem as a user, and I know a lot of other users have the same problem. So let's work together. This is all I have, Cameron. So you can.
Yeah, I think
take over.
There might be a couple other questions.
Oh, I see the one just posted. Yeah. Okay. Where does he?
Some of them are.
Wait, they kind of like jump. They get uploaded.
Yeah.
Which one? Oh, will you launch on other chains? I see. Yeah. So first, we're just gonna deploy to Ethereum mainnet, but then in July we plan to expand cross chain. So first of all, we can provide cross chain products. That's kind of like built in the architecture. So let's say if you have some liquidity on a side chain or layer 2, we can definitely provide coverage for that, but also do plan to deploy on other side chains. Right now, we can only do, and we focus on EVM chains, which are, Ethereum virtual machine compatible. So, one of the popular, for example, Binance Smart Chain, right? They run underlying same bytecode, and so we'll be able to easily provide coverage products there. Okay. What do you think Satoshi Nakamoto thinks about Solace? I don't know. I doubt he like knows about us, if that's even a person. But that's a funny question. I mean, I'm sure he's stoked. Like, that's all I can say. Okay, so will the app automatically load all your position across different DeFi protocols? So yeah, that's a great question. Basically, as I said, that byproduct quote page is gonna get done next week. But basically, what the process is looking like, you would choose the protocol that you want to get covered on, and then we'll show you all your positions there. And so you can choose all those positions that you want to get covered for, and then just click confirm and buy. So we will display your liquidity positions, just like you can see on these DeFi dashboards like Zapper, Zerion, InstaDep, and others like DeFi Saver. Okay, and then what a Sol is looking like in 2031. That's 10 years from now. I mean, I would say we would be the biggest coverage protocol. Definitely in decentralized finance, we can offer a lot of efficiency, and the goal is really to not just, be bigger, better, and the best, but the ultimate goal here is to provide efficiency in the whole decentralized finance space. Because right now, only about 1 to 2% are actually covered across like all that TVL. So we saw that chart. It's massive. You have billions and billions of dollars there, but only a tiny fraction, under $2 billion, are actually covered. So virtually all those funds can be just taken away. And by providing coverage products on the market, first of all, you covering already what's out there, providing more efficiency and safety. But then on top of that, you allow more users to join the space, because right now a lot of people don't want to use all these risky DeFi protocols, because they just they can lose the money. But what if you provide a good solution for the risk management? Now you open up the floodgates there, and so you can have way more capital join the space and grow the decentralized finance product offering. All of that, basically the whole ecosystem grows. So DeFi coverage, DeFi insurance, that whole space has been a huge missing Lego piece in the whole ecosystem right now, because we see a lot of these DeFi yield aggregators and protocols pop left and right, offering different financial products. But DeFi insurance, these coverage products are still not as popular.
I've got a question around like institutional adoption. I mean, like once institutions start playing more and more DeFi, well, one, what do you think is the status of institutions speculating in DeFi now? And what do you think their, I guess, interest in DeFi insurance would be?
So right now, institutional investors don't really participate in DeFi. Like, I mean, very few funds, like A16Z, for example, they do hold the tokens. But right now, most of the funds and big institutional players, they kind of just sit on their Bitcoin or Ethereum. Nobody really utilizes all those financial products that are out there. It's mostly driven by retail or like whales and some like smaller funds speculating. So there's still a lot of capital that is like sitting on the sidelines. Like even if you just think about Bitcoin, you can utilize your Bitcoin on Ethereum network using these financial products, but most of it is still, not utilized anywhere. And most of the institutional investors just like, they don't want to take on the risk. Like for them, for huge billion-dollar funds, for them just buying Bitcoin, it's already a huge risk. But we've seen a lot of interest this past year from them. And so I think that whole interest is just going to keep growing in the whole space, and then also in the DeFi. So, but for them to really come in, they need efficient markets. They need wide availability of the products that they can use in order to like execute their strategies. And options is like one of them, but also coverage products and insurance. Because if you're going to put a few $1 billion into something, you don't want to lose it just for somebody to come in and take it. So I think even though DeFi is blowing up, pretty much most of the institutional investors are staying away from it. And that's partially because of lack of coverage products.
That makes sense. Cool. And what do you guess like are the biggest barriers to adoption of coverage products? Like if you were to name the specific ones.
So I think generally speaking, it's low awareness of the users, and then also inefficiencies. Because like as I said, I wanted coverage product, but I still have never bought a single one, because they're quite inefficient. There's a lot of drag there in the market, and they're expensive. So I think all those challenges that I mentioned in the presentation have to kind of get resolved for a wider population to participate and actually get covered. So I would say, you know, just like these general challenges of like capital efficiency and drag on like claims, the way the risk management works, I think solving those issues and challenges would really drive adoption, just for the existing users, but also you have a lot of capital sitting on the sidelines because they can't afford losing and like taking on so much risk, and there's no way for them to trade off that risk. There are a lot of people that want to, you know, participate and get a little bit of the reward, but right now for them, risk to reward ratio is way off.
Cool. Well, if there's any other questions, we're going to move this to the networking component. Thank you all for joining us. And Nikita, one last thing is, where can people learn more? And is there any closing remarks?
Learn more about what? About Solace, or just
about you, about Solace, you know, about like specifically the project, and also what are you looking for from the community right now besides filling out this form that Kush attached? You looking to hire
just go to Solace.fi, you know, join our Discord, follow on Twitter, and then just come hang out, talk to us. We are looking for feedback, you know, on the web app, on what products you would like to see. We do want to know which products you're using, so we can like tailor our offering to your needs. So just come and engage. And as far as learning of like how everything works, I think the best way is perhaps like read the white paper. It's also like on just Solace.fi website. And then I'm sure you can just learn by clicking a few buttons on the web app, just get an idea of what it's like. And yeah, you know, you can ask questions. Just come ask me questions on Discord. I'm always available for that.
Cool. Awesome. Well, thank you so much for joining us. We're going to hop into the networking. Make sure to turn on your mic and camera, and see you there. Thanks again, Nikita.
All right. Thank you, Cameron. See ya.